So the banking system is on fire again, and this disaster isn't gonna end. As long as interest rates stay high, we'll see more pain for the banks. And earlier this month, Moody's downgraded 10 regional banks, but this downgrade spree isn't over yet. Liquidity is still an issue, and commercial real estate is still a time bomb, and the Federal Reserve is gonna turn up the heat. In our lead story today, S&P joins Moody's in cutting US banks amid tough climate, and this time 5 more banks were downgraded, and it all has to do with higher interest rates and deposit outflows. The banks just don't have enough liquidity. S&P lowered their grades by 1 notch, and these aren't exactly tiny banks. Comerica is number 31 in America, while KeyCorp is a top 20 bank with over $190 billion in assets. And this is very ominous because we know what happened back in 2008. The ratings agencies, they were slow to downgrade the mortgage bonds until the meltdown started, right? And this time they aren't going to make the same mistakes. The agencies know the banks, they are sitting on a powder keg and they are getting clobbered from every direction. The economy isn't resilient no matter what Joe Biden is trying to sell us. And here's what S&P said. The banks have below peer profits, high unrealized losses on their assets, or meaningful exposure to CRE. And all these are results of a higher interest rate environment, something that Wall Street can't really control. And if we want to point fingers, we need to blame the Federal Reserve for hiking rates and the US Treasury for flooding the market with Treasury bonds. And all that selling is making bond yields fly up and adding pressure to lenders. But if you think yields are going to go down, we have a deadly warning from Bank of America that things will not go back to normal. We will be trapped in a world of high inflation and higher interest rates. And it's going to be a 5% world where bond yields are pushing higher. It's a whole new world, but Aladdin won't be in it. Yields in the longer term debt will be repriced up because investors will demand more return to hold treasuries. We can see the 10-year yield breaking well above 4%, breaking the trend of falling yields. We could be stuck in this limbo of higher rates for longer than we like. And this new regime might last for another 12 to 36 months. We don't really know. So if you're hoping for rates to drop dramatically, you might be waiting for a very long time. And for investors, this is great news, right? Because now you get a higher return risk-free. 5% guys for doing absolutely nothing is awesome. But for the banks, this is a total disaster and a double whammy. The cost of borrowing will be heading up, which means more loan defaults are coming. The average depositor has also grown a brain, and they'll run towards government bonds to lock in higher rates. And when this happens, more banks will be in serious trouble. And it's not just the regional banks in trouble now. S&P was just a preview. The entire banking sector is now at risk for sweeping downgrade as well. In a stunning admission, the ratings agency Fitch warns they might be forced to downgrade dozens of banks, and that includes the granddaddy itself, JP Morgan Chase. Looking at the assessment of US banks, we can see a whole list that could drop in ratings very soon. At the very top, you have your JP Morgan and Bank of America. Even those could fall down from AA- to A+, which is a big reputational blow. But the big issue lies with the regional banks right at the bottom. Many of them could slip towards below investment grade. Now, if you think the banks had a problem raising funds, just wait until they drop in ratings, then the real crisis will begin. So if you're invested in the regionals, things could get even worse before they get better, if they even get better, right? And the real problem is banks getting locked out of the debt markets. The risk of defaults is real. And if I can get a 5.5% with treasuries, I will demand 7% or even 8% to touch any bond issued by a regional bank. And this is coming at a time when lenders are facing a liquidity crisis and declining profits. So it's a deadly spiral down to hell. And because funding is drying up, these banks are going to pass this on to the consumer, to you and me. Borrowers on the street are going to feel the heat, which is pushing this resilient economy, right? Resilient economy closer towards a recession. And I don't think Bidenomics is really working out, guys. And the real economy is about to get clobbered even more. According to Fed data, US bank credit contracts and loans are still dropping sharply. And in today's credit-based economy, this isn't good. Whenever bank credit drops, it is a canary in a coal mine, telling us that a slowdown is coming because money simply isn't flowing. Overall bank credit has fallen down to 17.2 trillion, which is the second straight year-on-year drop. Now the US economy, the global economy, everything runs on credit. And when that starts drying up, nasty things start happening. Just look at the plunge of bank credit. It has entered negative territory for the first time since the '08 crisis. In the real economy, the small businesses are actually contracting. The only thing really keeping us out of recession is endless deficit spending, and I'm really not sure that that can last forever either. So let's come back down to earth and really assess the situation on the ground because it's getting really ugly. US corporate bankruptcies have surged in the first 7 months of 2023. Just look at the carnage. From January to July this year, over 400 companies with $2 million or more in assets went under. That's more than the total bankruptcies in 2022, and we probably might end the year off with 500 or more. That's close to the lockdown levels when the whole world was ending. So we are going to have a reality check very soon because if interest rates go higher, more businesses will collapse because of declining credit. Remember all those figures about high employment and job growth? Well, it seems they might have got it wrong. In a not so shocking report, 500,000 US jobs at risk of vanishing in payroll revision. And this is ridiculous. 500,000 jobs disappearing is a dramatic revision that tells us that the economy is much weaker than we all expect. Apparently, things are not robust, and people on the street are actually finding it tough to get work. Perception control is key, and it's getting harder and harder to trust all these estimates anymore. So is the economy robust or is it in trouble? I'll let you be the judge of that, guys. But we aren't out of the woods yet. Things are about to take a darker turn for the banks because now the FDIC is coming for them. If there's ever a liquidity nightmare, a crisis, this is it. They're about to propose a new bank resolution that will squeeze lenders even more. Listen to this. The FDIC wants banks with as little as 100 billion in assets to issue enough long-term debt to cover capital losses if they ever fail. And let me translate this for you. The FDIC wants the banks to borrow a ton of money for the long term to cover their depositors. And on the surface, this sounds like a great idea, right? Let the banks keep themselves solvent in case of a bank run. Yes, it would solve the immediate need for liquidity. Banks can go out there and issue a bunch of 10 or 20-year bonds to raise cash. But here's the issue. Interest rates are at an all-time high. If we look at the yields of the 10 and 30-year treasuries, it is above 4.2%. And that means banks have to issue bonds at 6, 7, or even 8% to get any buyers. They need to account for that added risk by jacking up yields to find buyers. And this is going to squeeze their profitability even more because they'll be borrowing money to raise cash that will just be sitting in a vault, right? It's emergency liquidity that they can't afford to use. They can't just touch it. So it's the additional cost of doing business that will just crush profits even further. And guess what caused the recent downgrades by S&P? Declining profits. So we might be seeing the start of a gigantic flood of bonds from the commercial banks, and we don't know how high yields can go. And according to the Banking Policy Institute, with this proposal, the government will be forcing a large supply of bank debt into the market, but it is unclear whether there's going to be sufficient demand for it. The banks aren't just selling into an empty market. We have the Federal Reserve selling its own stash and Janet Yellen dumping treasuries as well. It's like a tsunami of bonds about to drown the market, and the real victims could be the regional banks. And let me show you why this will crush banking profits. Let's say you raise $1 billion in cash selling long-term bonds at 7%. You can't loan that money out. You have to sit on it, right? And the only place you can even think about stashing it is in the reverse repo market. You can get your money out the next day, so it's kind of liquid enough. But take a look at the interest rate there. It's only at 5.3%. So you'll be making a 1.7% loss every year, which is around $17 million down the drain. And when the Federal Reserve cuts rates, you'll earn less from the repo market while you are locked in into a higher yield from your long-term bonds. The payments to bondholders have to continue at the agreed rate, so the bleeding could increase to $30 million or even $50 million annually. And that's why there's no escape. If the FDIC forces the banks to borrow money, their profits are going to take a hit year after year. And if the banks feel the squeeze, guess what? Everyone else will feel the heat. Main Street is going to feel the pain, and the weakest link is commercial real estate. Now, there are 101 things that could really break the markets, no one really knows, but commercial real estate looks to be the next domino to fall, especially if the bank lending dries up. We are seeing more borrowers throw back their keys to the banks because it just doesn't make sense anymore. real estate prices are crashing down across the board. And to no one's surprise, office buildings have been hit the hardest at 30% down over the last 12 months. And it's getting so bad that the banks themselves want to dump the loans. And why? Because office mortgages are starting to default massively. Just within a year, 12 months, we are seeing a dramatic spike in delinquencies from under 2% to over 5%. Borrowers are defaulting on their payments and the banks are going to take more hits. So a deadly storm is brewing over the next 3 to 6 months. So if the FDIC goes through and forces the banks to borrow money, we'll see higher rates across the board. Plus, we still have rumors that the Federal Reserve will hike further. They have lost control of inflation, it is not transitory, and now they have to stuff the genie back into the bottle. I hope we understand there are more headwinds coming for the banks, but it affects all of us as well. If borrowing costs head up, consumption will come down, and commercial real estate could very well implode. And just because the Federal Reserve they bailed out the banks previously doesn't mean power will backstop real estate this time. So let me know what you think in the comments below. Are the regional banks in big trouble? And will real estate trigger the next banking crash? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.